For those of you that were in the first divestment session today, you might notice that this panel is significantly different. In the first panel, we had a collection of student speakers talking about their own divestment campaigns on their campuses, and it was a discussion about tactics. It revolved around the idea of the divestment campaign as a very political movement that's building towards something. And this panel represents to us the flip side of the divestment coin. That is, what fossil fuel divestment means from the investor perspective. We can talk to our trustees and to our blue in the face about how fossil fuels are going to ruin the planet, and therefore we should just weaken their political power as soon as possible. But it falls on deaf ears unless they hear some actual numbers, anything actual about divestment or investment related to that, because it's certainly not the students' backgrounds. So today we've assembled a panel of 3 professional investors to come talk about that exactly, because we feel that both of those sides of the coin are what's necessary for a successful fossil fuel campaign. I have here, in reverse order, there's Bill Page, who's a manager of Geos, former vice president of State Street, I believe, and now vice president at Essex Investment Management. So I'm going on the top of my head here. Natasha Lamb is in between the two. She is a corporate shareholder advocacy, part of the corporate shareholder advocacy team at Trillium Asset Management, and she actually, I'm pretty impressed by this. She said in an email that she has been really successful in talking to natural gas companies about trapping their fugitive methane emissions, which is great because that's really the biggest thing. That's the biggest, reason why methane or natural gas right now is not a sustainable thing. And if they can deal with that, maybe it'll be sustainable. Fine. Then on the far end is Todd Walker, who is the manager of the Vermont station of the Progressive Asset Management Group. All 3 of their companies are socially responsible investment companies. And I don't know, I'm really excited to hear this presentation. Todd's up first, so maybe we're ready. Thank you.
Okay. I was curious, we have a very small group here, so I don't know about the big lecture format. I'm just curious, how many people are here to learn about investing endowments or organizational pots of money? And how many people are here for their own personal investments? Okay, so I just want to get that out. I'm sorry I wasn't at the session this morning, but I've been through a lot that are like that about investment. And I guess one other question, how many people here are professional investors themselves? Okay. So, I don't know what they covered. Did they cover anything this morning about investing itself and how it works? It was just really just...
I doubt it. I actually was running around fixing other problems during the time. Maybe
was there a lot of talk about that? About how
no, it's more strategies, organizing, those kinds of things.
Well, my experience, I'm in the group of Progressive Asset Management. We do primarily retail management of individual portfolios. We don't do a lot of endowment management. I have been involved in a couple of schools in investing. One is Green Mountain College, which is right in Pullman. And my experience there, I'll talk about that first. My experience there has been that typically the endowments obviously run by the college, and they listen to students, but they also are very committed typically to the manager they're already using, whether it's a bank or some sort of institutions manage the money. And then the students then get in some sort of committee where they try and influence the decisions. And then a portion of the endowment will be divested, I would say, or just assigned to social responsible investing. That's what happened in Green Mountain College. When it comes to divesting, in my experience, because I do it more on a personal level with my clients, it really is not that difficult. I shouldn't be little. I mean, it's fairly easy to avoid oil companies and gas companies, people burning carbon. There are various groups that help us screen for that, but it's a fairly easy process. look at a fair person's portfolio, and depends on, a lot of our clients, it's interesting, they don't, they really dislike big oil. Gas seems to be more acceptable. So we have clients who are okay with gas because one of the main tenets of social responsible investing is it really is up to the client. The client's definition of what social responsible investing is. And I guess it would also be, down in committee or whatever. We don't really tell the client what to believe, or we're not. Some invest in a mutual fund. The mutual fund will try to screen, or we actually have individual screening for each client. So our clients are given a questionnaire. They're asked what they feel strongly about. You are against oil, gas, alcohol, child labor, pornography, and we get answers all over the map. So that's, and then we construct a portfolio accordingly. So this investment movement is terrific. And we just actually, in our latest newsletter, we just interviewed Bill McKibben. But really, it's this process of investing in screening has been going on since the 1980s, when the social responsible movement was born. So my sort of role in this panel is to just generally talk about social responsible investing, and then moving on to more of the specific portfolio strategies, which I guess is
Something going on.
How many people here are familiar with the whole tenet of social responsible investing and how it works and all that? There's one important thing in social responsible investing is it's easy to say, or it's easy to understand that it's about boycotting, which is really what the Divestment is really saying. We're going to boycott the stock of big oil companies. That's effective to a certain extent, but I think it's important to understand this is something that I don't want to get in trouble. This is being recorded. With the gods of investment. But it's important to understand that most vast majority of stock that is in the marketplace in circulation is in what they call the secondary market. It means it's been issued by the company a long time ago, stocks and bonds. They've been issued by the company a long time ago, and the company was paid at that point. People bought the stock from that, and the money goes to the company with some of the underwriters. That's when the company actually gets paid for the stock. After that, it goes into the secondary market, and it's traded in the secondary market between you and me and everyone, of course, around the world. And when you boycott that stock, you're not immediately damaging the company because the company's already got the money. So I think it's important just to understand that. I'm not saying this, and I talked to Bill about that, and I actually addressed it, how do you feel about that? And I guess the answer is that, as far as investment, that it's another way to call attention to the problem. That they understand this is going to bankrupt Exxon, but it's another way to create attention to a very serious problem. The one way but it doesn't really come up very often, the one way that would be extremely effective if you could somehow boycott the stock that bonds the companies were selling as new offers or initial public offers, that would be immensely effective. But it's not, typically that doesn't come through that often. And there are many other people, unfortunately, who are willing to buy it. The comparison they make is with South Africa and the apartheid. And that was really a different situation because we had very large institutions investing their investments out there, like the pension plans and the endowments, investing in investments from a relatively small country and relatively few institutions. So if you do that, it's much more effective. But I think it is still a very, very effective campaign, but I think it's important to understand that as a boycott, I think it's going to be more about public relations than it's actually going to make Exxon crumble or the other way. Where there's, in my opinion, more effectivity or more results is on the other side of social responsible investment. So there's actually actually three cornerstones of social responsible investing. One is negative, boycott. The other is positive, looking for things to invest in. And the other is social shareholder activism. And this is any people familiar with shareholder activism? Anybody? Most people know. So that's the other side of it, where you engage companies through shareholder resolutions in their annual meetings and through proxies to make changes. They're not binding. That's the thing a lot of people don't understand. These votes you can see that in the annual meetings, you can't just have a vote of the shareholders to force the company to change. What it does is, if it's a large vote, the company has to pay attention to it. They just can't ignore it because it just it's a majority of the shareholders want it. Even if it isn't a majority, it calls things to the company's attention. But what happens very often is the company doesn't want anybody to be brought attention to this resolution. They don't want it to become public. And so what will happen, they'll actually work with the people who are filing the resolutions to essentially say, look, if you take this resolution off and don't go through with it, here's what we're going to do for you. We're going to set up a committee for you and we'll really into this. And this has been very effective. I think in many ways more effective than boycotts in changing company behavior. So I just want to bring that up, that I think that's a very important thing also to look at. How many of your time?
Got a lot.
I got some
12 minutes.
12 minutes.
So
Make sure I don't go over. That's it.
you can stop the questions too, right? If you want.
Pardon?
I said you can stop early before you 12 minutes if you want to take questions as well. That's your deadline.
Another part of community investment, another part of social responsible investing is very important, is community investing, which is another, I think, very big part of this summit, which is about the new economy. And that's a different side where you essentially have the money go directly to people in the community through typically community loan funds, where there are no associated with that. And we do a lot of that. I just want to sort of give an overview of social responsible investment. We've been doing this for quite some time. And I think that the investment campaign is very powerful. But the other thing that I did want to talk about is that when you, and I talked to Bill about this, is that when you boycott, then where does the money go? What to invest in? Well, part of it is community investing. And part of it is companies who want to foster and support solar companies, other companies doing things that help solve one of the underlying huge problems in all this. Again, I don't want to get in trouble, but I tend to be a bit of a gadfly. I particularly have an issue with attacking the oil companies as sort of the villains in this. I think it's all our understanding, or we all understand that, well, maybe we don't, in a sense I'll say myself. They're selling us what we're buying. We're buying oil. We drive here, we consume gas, we heat our homes. And I think we paint the owners of these companies as Bill's calls them rogue companies and villains in some way. They're not villains, in my opinion. They're just merchants. They're businessmen, and they are not looking to take their vast reserves of oil or gas and burn them. We can't wait to burn this. They're being asked to burn it every day because we're buying it. We are buying their products, and they're merchants. As long as someone's willing to buy it, they're happy to sell them, and they are happy to increase the shareholder value. Their sensitivities aren't very good, in my opinion. I don't consider them evil, but they do things like Exxon, for example, right now is still out in the market for renting single-hull tankers. And you think, how stupid is that? But as a business decision, getting away from ethics and the environment, as a business decision, it's actually pretty clever because what they're doing is single-hull tankers are still out there. They're much cheaper than double-hull tankers. So what they do is they just get a massive reinsurance policy and figure, what, the chances of a Valdez again are pretty slim. So we just get a massive reinsurance policy, and if it happens, then the insurance company will pay it off. In the meantime, they're producing more profit for the shareholders. And that's how they see it. They're merchants. The key behind this for me is to increase consumption, obviously. And in the investment side, I think what's happening is you're going to see more and more moving to electricity because it's clean, because they will be transmitted. So for our clients, if you look at things to invest in, we were doing solar, we were doing a lot of wind. The problem is that those areas are monetized. It means no one came out with a killer, I don't want to say app, because now that means something else, application, but no one came out with a killer product that no one else can imitate. They basically were mostly the same. The panels are vanilla, the turbines are vanilla, and therefore you just got this tremendous competition going on around the world with the Chinese moving in, and they just became a commodity, and companies produce these things and the stocks just collapse mostly. But one area that is not doing well is utilities. And there are a number of green utilities because when they deregulated the utility business, they essentially allowed electricity to be bought anywhere in the grid. Instead of saying before utilities had to be Detroit utility, Boston utility, New York utility. Now you can have utility in the middle of Canada someplace, and they can be selling into the grid and being paid. So you'll see a bunch of these green utilities that do have stock, a lot of them are Canada. It's been very rewarding for my clients to do something like that because they're up and running, large companies, producing green energy with some stability and some dividends. So it's just an example of, I think, as you look for something to invest in, it's important to look for something that's going to increase consumption, at the same consumption of greenhouse gas, creating greenhouse gases and oil and all that. I'm getting probably off the subject of the divestment. I'm just trying to think that if it came out of a session like that, the thing you want to hear is what would be the system doing that. And as I said, typically, my experience has been the college doesn't turn around and hire someone like us. Unfortunately, or fortunately, because we're a little bit too radical, perhaps. So they will typically use the manager they have. What I have done, you might want to consider, is hiring a consultant that then works with a manager who is already, managing their money. Because typically the college will not say, and that's where you're talking about areas or your town, I guess there's 11 towns or something that not are investing. The college will, a town or an institution will not say, oh, we're just going to get rid of Key Bank. They've been managing our money for years, or we're just going to get rid of Merrill Lynch or whatever. They're going to say to Merrill, okay, look, we want you to take 30% of that portfolio and make it social. And Merrill may say they can do it, but it's not by getting that consultant there who's an expert. Help them to figure out their green portfolio. So that's about it. I think all I have, I think maybe, are you doing questions per person?
Yeah, so
That's probably better because I hope I'm not way off target.
No, you're not. So the way, I'm sorry for not laying out the format that we have, the way since doing this, each panelist has a total of 20 minutes. You can, if you're answering, you can take questions up until that 20 minutes. And then after each person, there will be a longer discussion, and then we have a couple of questions after that.
So I'm probably 20 minutes.
You have 5 more. Questions for Todd, anyone?
Yes.
Two simple ones, I guess. Chemical Bank is the #1 lender to the energy business.
Yeah.
Would you divest of Chemical Bank? The second question is, when you have your client negotiate a list of allowables and non-allowables, how does that change your benchmarks?
Well, the benchmarks, using conventional ones like S&P 500, that kind of thing, or use KLD 400, it wouldn't change benchmarks that much because there aren't any, what would be benchmark, US X porno, I mean, there's not one I could go
S&P X oil.
or something like that. There's not one like that. So I'd have to use the general benchmarks or something like KLD has one, but that's over it's called KLD 400.
Nice.
But I wouldn't change the benchmarks. The first question, I'm sorry.
When do you draw the line in terms of what's socially responsible?
Oh, well, it's That's why people like Taylor exist. I mean, that's or did or whatever they are now. It is subjective. That's what I mean. I have my best and worst clients are vegans. I love them to death. I wish I could be vegan myself, but I just can't. But because they're great. They're activists and they're tremendously committed. But it's very difficult to invest in them because, believe it or not, especially in mutual funds. So it's very subjective. And that's why we make customized portfolios. And that would happen in college as well. I mean, you're going or an institution. That's what the committee is all about. You have to decide what is social. And then besides that, throwing on here, but socially responsible investing is more, especially over the last 5 years. It's social responsible investing, impact investing, ESG. I mean, there's a lot of this sort of, well, I don't know. Can you tell them what's about it? I think a lot of it is being watered down, maybe in a good way, so that institutions can accept more. See, an institution like Harvard is one so says we do social responsible investing because, in a sense, they're making that judgment call, and they've got many other factors. It could be donations and endowments and libraries being built by Exxon or whatever. They can't make that statement. So what you get is they're saying they have ESG, environmental, social governance, and they have impact. These are a little bit less strict. So, sorry, go ahead.
Hi, so I just wanted to kind of maybe challenge a point that you made earlier. Whoa! Yeah, and like maybe you can provide more insight to kind of where you're coming from on this. Like you had said earlier that you didn't feel like the fossil fuel industry were like villains. And I guess and you had also said that, all they're trying to do is meet a need in the market.
Yeah.
And I guess my question is, when we have evidence that these companies are like diluting our democracy with like tons of money, silencing scientists and creating like a situation where it's inevitable that we're addicted to what they're selling us. Like I guess how else? I don't know how else to define a villain, but like I would consider that like pretty horrible. And I guess another thing you had said is that they're not, it's not like they want to burn the resource, the carbon that they have, and like I think pretty much ubiquitously there seems to be common sense around the fact that they're actively, promoting the value of their companies based on carbon that's below the ground currently. So I guess I wanted to hear what you thought about that, and I guess where you're coming from in that finding them as maybe benevolent.
Well, I think you're totally wrong. No, I just always want to do it.
Yeah.
Sorry, my son, this is the kind of answer I got from my son. What I mean is that they're merchants. Yeah, they're going to buy cars. Monsanto does too. I'm sure that public broadcasting may not buy a congressman, but they're certainly in there taking dinner and lunch. And this is, I'm just saying, this is business. They're not, but what I'm saying, they're not villains going, wake up in the morning and go, how much can we burn to increase the CO2? This is just a byproduct of what their business is. And it's wrong. I wouldn't do it. I wouldn't be the head of Exxon or be involved in it for a second because I don't want to. I know I really care about the environment, but I just think it's wrong. I think it's wrong. Or let's put it this way. I ever hear a better word than something controversial. So I think it's more adult, frankly, to say it's our fault. This is our fault. We're consuming this stuff. We're empowering it. And as soon as you stop buying them, it's like those science fiction movies. You cut off the cord. As soon as you stop buying, these people they shut down. You don't buy. They cease to exist. Or they would have to run around and do what they did years ago, which is to buy a little solar and everything else. I mean, that's not saying they're business people, and I don't think we should villainize them. That's where we turn them into some sort of plot. You're getting my lecture I give my son now. But that's what I mean. I think they're business. We got to take away their product. Sorry.
No, it's okay. I'm sure that this discussion can go on for a while. I got up again during our discussion.
You do want to say?
Well, it was just a follow-up that letting them off the hook because they're business people is saying, well, they're just criminals. So that's what they do. It's fine that they murder people, or that they rape people, or that they steal from people, because that's what they are. That's what they do. You can't let them off the hook just because that's the way they operate.
But I'll make it really fast. See, that's what the business that I'm in. The business that we're besides analyzing, we have a double bottom line. We have to analyze a company to see if it's profitable, because it's just what they do as a business. And then we have to look at the ethical leadership of it. And that's the business we do. Yes, we look at Exxon and Monsanto, like Monsanto. GMO is my thing. My clients each have a passion for nuts. They go nuts and GMOs. Because what Monsanto is doing is basically, whatever. I don't get my thing in that, but when we look at a company, yes, I think they are criminals in a sense, but they're business criminals. It's business criminals, and then we try and find management.
That sounds like a villain to me.
No, what I mean is that we try and find business people who are not criminals, but I don't think that I think that they think that they're wonderful. They go home at night and say, "Jesus, look at this! I made this extra money, a miracle to get that contract down in Dubai or something." I'm sure
Lots of mafia people are good family men.
Or if you don't think you're a criminal, then you're not a criminal.
Well, I understand. It's just I don't think they're doing that. They're not doing
Come
that.
on in just a second. Sorry. We'll come back on it. I promise.
I gotta go.
Absolutely.
Oh, I'm sorry. Yeah. It's another.
And do this. Okay. Even he has his head. Yeah.
So I know there's some button
Oh,
that I need to push. And I was just talking with Bill, in case anyone is curious, I am 8 months pregnant. He doesn't ask anymore, which is a wise choice. But that is in fact the truth. So good afternoon, and thank you. That was a great introduction. And I think it's stirring a lot of emotion and passion and excitement in the crowd. And first, I'd just like to thank everybody for their interest and enthusiasm around the subject. I think sustainable or socially responsible investing has become a very relevant and timely topic given the 350 divestment campaign. And I'm happy to be here to talk a little bit about that and also how you can best leverage your power as investors to make a positive social change. So I'll just give you a quick introduction to Trillium and also to myself. Trillium has been engaged in sustainable or socially responsible investing for about 30 years. And I've been there for about 7. And over that time, just to kind of give you an idea of what the firm is, we manage about $1 billion in assets for high net worth individuals and institutions. I've been there 7 years, and over that time, I've helped to develop and evolve our strategies. I worked as a stock analyst, integrating the environmental and social factors into the financial decision making, and also for the last 6, maybe 8 months now, I've been working on the shareholder advocacy side and corporate engagement side, trying to shift corporate behavior towards more sustainable outcomes. Our mission is to offer superior investment returns while integrating these environmental and social goals, and also evolve the capital markets so that sustainability becomes more of an embedded piece of financial decision making. So there are a host of strategies that we employ in terms of sustainable investing, and Todd did a very good job of outlining some of those. I might just go into a little bit more depth in my presentation, but basically, these tools allow us to align an investor's values and leverage their position as shareholders as well. And traditional SRI approaches, which Todd spoke about quite well, have focused on negative screening and screening out companies that are considered, whose products and services are considered detrimental to society. So a company that's producing nuclear weapons, pretty has been the shift, and I would say definitely in the last 5 years, there's been a shift towards integrating the environmental, social, and governance factors across all industries and across all stocks, and considering all of these factors, not just for what were traditionally thought as the baddies, but for all stocks. How does it impact financial value? How does it impact the ethical leadership of a corporation? And in addition to the kind of ESG criteria that I just spoke about, we also layer on shareholder advocacy, which is what I've been engaged in, and we can talk a little bit more about that. Community investing that Todd introduced, and also engaging in public policy. And just one quick note on the public policy front, I think the divestment campaign in and of itself, apart from just saying, oh, we're not going to invest in oil companies, is very much a political campaign to draw attention to what's happening and trying to change the rules of the game so that they aren't unfairly tilted towards oil companies, which can allow some of this, I would say, more criminal behavior. So I want to talk a little bit about investor demand for sustainable investment strategies and how investors can align both an internal or ethical mandate with a more external mandate, that is what's happening in the greater world that we're all affected by. So in many ways, aligning internal and external mandates is about aligning your values with your investments, and also trying to create value as an investor, because that's what you're doing. That's the point. And I really see divestment sitting at the nexus between that values-based decision. I think Bill McKibben does a very good job of saying this is a values-based decision that you're making to invest in fossil fuels, and also recognizing the regulatory and global pressures that will really undermine fossil fuel extraction, or should undermine fossil fuel extraction in the future. And so if those reserves can't be burned, then we shouldn't be valuing them now as part of the stock. Fossil fuel divestment in general is a two-pronged strategy. So there's a negative screen there, not investing in fossil fuel companies, but there's also a positive screen attribute, which Todd alluded to, which is you want to redeploy those assets in a way that's impactful, and also in a way that hopefully acts as a proxy for energy exposure in your portfolio in general. So that could be investing in energy efficiency, alternative energy, solar, wind, and the like. Some of the work that we've been engaging on the policy front right now is working to create pools of investments where you can actually invest in solar development projects rather than just the solar manufacturers, which it's problematic, right? Because it's become so commoditized. The actual panels themselves, and prices have dropped, and margins have dropped, and companies aren't making as much money as they probably hoped that they would be at this point. But investing in solar development projects, for instance, offers very steady cash flows and cash streams over a period of time, and could actually serve as a proxy for utility exposure, for instance, where you're getting kind of these consistent returns. And the same thing with energy efficiency. And so we've been engaging on that, thinking about it from a REIT structure, which is a real estate investment trust. So right now you can invest in a real estate investment trust in a broad portfolio of buildings, but you should be able to do the same thing for energy efficient buildings. That's the theme of the REIT, or invest in a broad portfolio of solar assets. So it's kind of an interesting, strategy there that should continue to evolve over time. And let's see. So just one other thing I want to touch on this slide are these kind of physical, regulatory, competitive, reputational, and social pressures that have shifted the reality that we're all living in. So it's not just about the internal mandate, it's about what's going on in the world. And socially responsible or sustainable investing is really seeking to be responsive to that, rather than just reactive, rather than waiting for things to happen, but to see these emerging issues on the horizon and respond to them appropriately before they bite you. So we all know the problems, both environmental and social, and we really seek to invest in those companies that are innovating and creating the solutions. And so whether that's sustainable agriculture, clean energy and efficiency, supply chain responsibility, there's a whole host of solutions. And our sustainable opportunities portfolio is one of those strategies where if we're both divesting from fossil fuels, so we're not taking on kind of what those future pitfalls of having fossil fuel exposure might lead to, but we're also investing in positive themes. So for the sustainable opportunities portfolio, there's three main positive strategies. One of those is investing in green solutions, the other is healthy living, and the third is economic empowerment. And so these are some of the classifications that fall under those headings. And a company that is in that portfolio would have to be engaging in one of these activities in some sort of meaningful way. And this is technical stuff, which I'm sure you guys aren't interested in. But it does get to the benchmark question a little bit. We're using the S&P 1500 as a benchmark. We're more alpha seeking, so if we think about our investment model, we're looking for outperformance versus just, and we might seek alpha more than we would seek benchmark returns. Because often with benchmark, and I'm sure you guys are pretty familiar with this, that's how investors measure the returns. They look at the benchmark, they look at how you've done, and that's how you've done. So if the benchmark's down 5% in 1 year and you're only down 4%, woohoo! But so there's something to be said for that, and there's something to be said for seeking alpha. And this has a little bit higher tracking error than the traditional fund, but it has since inception it has outperformed the S&P 500. So the other core strategy is integrating the ESG factors into stock analysis. And really what that allows you to do is identify what the risks and opportunities are for a company. And it varies depending on what industry you're looking at. So, risks and opportunities for a technology company are going to be completely different than they are for a healthcare company or an industrials company. And it's all about determining what the materiality of those issues are. So what would be the financial impact? And also what's the impact on stakeholders? So I'll bring you through a quick analysis. This is an analysis I did last summer on the software industry, so part of the technology sector. And this is our materiality matrix.
You have 5 minutes.
Okay, awesome. See, I'm being embracing the clock here. With the materiality matrix, you can see we're looking for those issues that a company is facing that are both of high stakeholder concern but also of high financial impact. And the intersection of those, you can see the bolded issues in the right upper hand quadrant. Those are the ones that we consider most material, and so we'll weigh those more heavily in our investment decision making. And so for this particular example, I was actually quite surprised. These are large software companies, and you would think that innovation would be incredibly important to them. It should be. Only one of these companies had a strong diversity program in place for their employee base. And the stock at the top, Symantec, I actually ended up adding to our portfolio last June, which was fantastic. It's up 70% since, but it's I'm sure it wasn't only because of diversity. But you can see that a lot of the companies aren't doing well on that particular measure, should be material. And then kind of a sign of the times is that green IT, everybody has an offering, which is kind of a nice intersection between offering a product or service that increases your revenue opportunities. There's big growth if you can help a company be more energy efficient, but it also has that climate change benefit. Did you have a question?
Yeah, shouldn't data privacy be a bad thing?
Shouldn't what?
Data privacy?
Data privacy means whether they have a strong policy in place and oversight in place to ensure that there aren't data breaches and that consumer privacy is protected.
Oh.
So, the other piece I just wanted to touch on is creating social impact across asset classes. We talked about community investing a little bit, but we worked on this paper last summer. It's called Total Portfolio Activation, and we worked on this with the Tides Foundation. And activation really means with all of your assets, trying to have some kind of positive social impact. So for instance, if you're investing your cash, instead of just putting it in a money market, maybe you put it in a community development bank like Self-Help Credit Union down in North Carolina. That money can be targeted towards a solar project or women-owned business, funding a women-owned business. So there's many ways that you can deploy those assets. And I'm going to speed up a little bit here, but here's sort of a partially activated portfolio map where these investors, if you look at, again, the bright upper-hand quadrant, that's key, are investing in domestic stocks in a sustainable way, and a couple of niche funds. But the rest of their assets really aren't being deployed toward any kind of social impact. But with some tweaks and some changes, you can actually make a shift and really activate your whole portfolio across asset classes. And then briefly to touch on the advocacy side, this is what I've been engaged in the last, 8 months, and really, speaking with corporate management about and engaging with them about how they can change their behavior towards these more sustainable outcomes. We have a bunch of different priorities in this area, and climate change is definitely a big one. How many minutes do I have? 1?
Yeah.
So I'll bring you through, this will be my last thing, and this is to your point on fugitive methane. An example of this is, not all of our strategies avoid fossil fuels completely, but where we do invest in fossil fuels, we tend to heavily favor natural gas. And that's always been seen as sort of a bridge fuel to a more sustainable energy future and to more renewables and whatnot. But that's really come under question because of the methane emissions. So from the time you drill a well to the time that you burn that gas in a plant or at your home, there's methane emissions that are leaking throughout the value chain, and they have 72 times the impact on global temperatures that carbon dioxide has over a 20-year time frame. It's a huge, punch to the climate. And what's happened is that there's this incredible dissonance between what companies are saying those leakage rates are and what scientific evidence is showing. And when all of these studies have come out and shown really high rates that have questioned whether natural gas is actually better than coal or not. And even the EPA has failed to regulate methane appropriately. So you've got 7 states now on the East Coast suing the EPA for not regulating methane. So huge issue. There's also a business case here. So here comes the materiality piece, where if you're leaking gas, that gas is no longer available for sale. So you're actually really hurting your top and bottom line. So engaging with a company on this, we filed 3 shareholder proposals in the fall, asking for increased disclosure, measurement, mitigation programs. We have dialogue with those companies, and those proposals are going to a vote within the next month. And again, the vote isn't binding, but it's a strong signal to management to say you need to change the direction that you're going in here.
Button.
Is it this one right here?
Yes.
Okay.
Oh, I guess not. It should say PC on it.
It says PC, but it stays lit up. Wait. Did that change it? No.
So
So, when I talk about, at the risk of a lot of headline misconceptions, talk about clean technology investing, and I've done a lot of thinking about how do you sort of talk about the catalyst of clean tech, why clean tech is real, why clean tech isn't like Solyndra, and I think my focus is on listed equity investing, so it's investing in stocks as opposed to private equity investing. So when a lot of people think about clean tech, they think about direct investing. And when I think about the three greatest catalysts for clean tech, and I think yourselves right now, you're trustees of a foundation, you're institutional consultants. That's who I spend my days talking to. So I'm trying to present a business case in a fiduciary case of why this stuff makes sense. And it gets to massive opportunity in the part of investors. So I coined this term BTU equals GDP. So without British thermal units of energy, you cannot power an economy. The next 3 billion people, so we've all learned about consumer-based economies that are growing in India and China. This is happening at a rapid pace. So the pace of economic development coming out of the Industrial Revolution through the age of chemicals and cars to technology, media, and telecom to the internet took 150 years. We're doing that at 6 times a greater rate in 20 years, and the forces are much greater. And then the next is this demand, supply, and balance. So you learn from Economics 101, when there's a demand, supply, and balance, it's huge risk and huge opportunity. So that's sort of thesis 101 to you, because you're institutional consultants, you're trustees, so you need to take this message to them. But the major catalysts that are driving this behind are why you're here, is climate change and the rise of sustainability. So, but I can't go out to Cambridge Consultants or Mercer and say it's all about climate change, it's all about the rise of sustainability. Because they'll say, whoa, we have a fiduciary obligation on the part of this endowment foundation. But the beauty of what you're doing this weekend is the fact you're trying to get that sustainability kicker. So the great thing about the fossil fuel divestment movement is that it creates synergy and a catalyst. It brings people together around the rise of sustainability. And the rise of sustainability has been ethereal. It's really hard to get your arms around. So it's good because you're trying to branch. So to put it sort of in perspective, what I'm looking at, it's called GEOS. It's Global Environmental Opportunity Strategy. And again, as I said earlier, I'm investing in public equity. So these are stocks as opposed to direct investing. The firm I'm at is it's a firm that was founded in 1976 in Boston. It's called Essex Investment Management Company. We weren't founded in social responsible investing. We were founded in growth investing. So we go wherever growth exists. And I was able to convince the principals of the firm that there's growth in clean tech 4.5 years ago. I'm still trying to convince them there's growth in clean tech. My team, I work with one partner, Rob Yoki. I've worked with since 2004. We follow 600 companies, a lot of companies that we screen for technology, clean technology, and we put it into a 35-45 stock portfolio.
Was it working early?
So maybe you could leave that in and reopen it, because
Yes.
maybe when we took it out.
I can keep going, but I have a slide. The next slide is the slide I want to show you.
Well, you keep going, I'll deal with this.
So, so I've got a couple photos of the world that it's sort of the growing world and non-OECD economic development. So when you think about what's really driving natural resource pressure, it's the emerging market economic growth. So the developed economy across the world, we are the OECD region. And our region has been created in non-OECD economic growth, is now taking the baton of economic growth globally. There we go. Good work. So I view ambient light as a big proxy of the transition that's occurring right now between the OECD regions to the developing regions. So, we can't expect the Cape of Africa or Russia or China or India to light up like the eastern seaboard of the United
United States. But again, light is a good proxy for the transition that's occurring. So as this transition occurs, we're going to see increased consumption of goods and services in developing markets. And so how do we get there, right? So I guess the issue that I have globally is that it's not going away. And as you're probably aware, so we don't matter anymore in the developed markets. So all of the demand for energy is going to China right now. So commodity prices move in marginal demand. And all the marginal demand, the reason why Brent crude is up 200% in the last 18 months, which no one's talking about, is because of the fact that all the marginal demand is going to support an economy in China. If they slow down the economy, they have massive civil economic unrest. They have to keep this thing going. And they're doing it using all types of energy, but as you know, they've hit the limits to growth right now. You've seen the photos in Beijing and the Shenzhen region there. So the OECD region is the bottom of the wedge. We just don't matter in developed markets anymore. So I want to call your attention to Jeremy Grantham's work of GMO. He's a Brit. He's very concerned about these issues globally. And when you think about this is an index of soft and hard commodity prices from 1900 forward, and you'll see the 200% increase since 2000 in soft and hard commodity prices. And this isn't an economic issue; it's a secular growth issue. These are all new secular growth. So what we're trying to do with GEOS is find a way for economies to operate in this new regime when all the market demand is being taken from us by the non-OECD region. And the way we do it, and again, Todd and Natasha both talked very well about the decline of the solar industry. The beauty of that is that the adoption rates are improving. But when a lot of investors think about clean tech, they tend to think about solar and wind. And we define clean tech very broadly. So we're doing power storage for electric vehicles, we're doing electric metering, we're doing desalinization technology. Desal is incredibly energy intensive, as you probably know. This is a ceramic cylinder built to 0.001 nanometers, so it's highly tolerant, and it recycles brine in a desal plant and saves 70% in energy costs. So it's pretty good if you're operating in Dubai, which is where most of the installations are. Water filtration, polysilicon equipment, and then a natural gas engine block, and ultracapacitors. And ultracapacitors is the opposite of a battery. So you start-stop technology for cars. You put your foot on the accelerator, you can get up to speed immediately. So all that energy is spent. So it's the efficient use of scarce resources. Our philosophy is that companies that are positioned for this will do well over time. We're long only, meaning that we're not hedge funds. We want to find companies, buy them, support them. They need support. They're publicly traded, but there's not a lot of share ownership of these companies. The companies that work are at good, attractive valuations, meaning the prices are cheap relative to the oil price. We're kind of being an investor. So you, the fiduciary, you, Mr. and Mrs. Trustee, should look at this sector because it's strong growth and the stock's priced very attractively. We need to be consistent on risk management. So we're dealing with publicly traded stocks, so a lot of these technologies are quite commercially viable. They've been around for many years. But at the same time, there's some risk. We own some names like Tesla, which there's some adoption risk in electric vehicles, but we need to be very mindful of the risk in the cycle. The key thing, and the really interesting thing about clean tech, we see the most viability, is in sectors of the market where they're reaching their adoption rates. So LED lighting is something that is being adopted. It's energy efficiency, Todd mentioned, and Natasha. Very, very telling also, and a lot of opportunity. So we invest across 9 themes, and to us, 9 themes is what clean tech is. This is, you need to be thematic, you need to be broad when you think about it. So the work that's influenced me has been the work from the Intergovernmental Panel on Climate Change. Nicholas Stern is an economist commissioned by Tony Blair. I did a lot of work on this. Sokolov down at Princeton did a lot of work in the wedge theory. So I've been more influenced by environmental economists, and when you look at do the work on this, you can see that for decarbonization, resource optimization, new energy infrastructure, all these issues are related to climate change, all these issues are related to decarbonization, all these issues have enormous opportunity for you, Mr. and Mrs. Endowment. So this is opportunistic, this isn't about corporate governance, this isn't about, these are technologies that are going to grow in the new economy. These are technologies being adopted by multinationals now. as Todd said, yes, indeed, they're businesses. They like to put good things in their sustainability reports, but they also like to save money. And so they're adopting clean tech to hedge off fossil fuel use, makes good in businesses. So some of the examples, and I have to do a little bit of a disclaimer, this isn't stocks. These stocks that are held by geos and water and keep our clients happy. So Raven is we're doing a lot with agricultural productivity. Raven is taking the farmers have offices. Farmers have more IT intelligence than most people I know. And this Raven helps bring their planning from the office to the plow, to the agricultural equipment, to the seeds, and to the fertilizer application to increase yields, optimize yields, lower water usage. Kingspan is an efficient building materials company. LEED++, doing insulated panels, based in Ireland. You all know about Tesla. Tesla's a sort of an iconic clean tech stock. I think there's a lot of in the name to execute. I believe in Elon Musk. The guy's going to get it done. I think they're going to get acquired in the next year or two. They're really doing well with the IP protocol of their thermodynamics in the battery. There's talk we're going to start working with Boeing and the Dreamliner, giving them lithium-ion batteries for the Dreamliner. Capstone, thank God for the Capstone turbines in the hospitals in Lower Manhattan. Capstone does microturbines. They're agnostic on feedstock. They'll burn anything. But they work with zero emissions, and so they use for backup and primary power. As you may know, in India, the bulk of the telecommunications infrastructure is using diesel generation, and so Capstone is highly efficient. Renewable energy, I would say Enphase is the killer app in solar. One killer app we see, given the Todd's points, that solar is pretty uneconomic. The beauty for the manufacturer is really becoming more economic, but Enphase helps solar installation. It's safer, it's a microinverter, it's also more effective and efficient. And Belmont is an irrigation company. So irrigation is something that we just took because of the drought and now the flood. Our corn belt is now moving north. We need to do much more irrigation across the globe, and we like Belmont also does infrastructure development. And I'm going to close here and then take questions. And this is my sort of tough thing, right? So I kind of like to think that the world can't shop at Whole Foods and Prius, about Prius. And so what we try to do is we're trying to make the petroleum bubble work better and smaller. We're trying to take the gas bubble and bring that into the bridge. It is bridge fuel. We don't own gas E&P because of all the methane issues, but we do own natural gas engine blocks. So they're the beneficiaries of low natural gas prices. In companies that use natural gas engine blocks, the adoption rates are absolutely enormous for trucking, long-haul trucking. They're all doing it now. Meaning when I say they're doing it, they're adopting up to 30 to 40% of their fleet plans. They've started now to be within 3 to 4 years, 30 to 40% natural gas engine block, because it gives you more business risk away from diesel. You also surpass the EPA legislation for emissions. Coal, we have clean coal, meaning that we have a company called Calgon Carbon, and ADES. So the SOX and NOx rules for the EPA are going forward. We're going to take 30% of our coal fleet away in the U.S. in the next 24 months. Utilities know this. And we're helping with the high-end, highly efficient coal plants be highly efficient through scrubbing technology, through stat technology. Renewable energy, that bubble, news this week that we can be 50% renewable energy by 2030 globally. We can get there, so that bubble could go up. So as we see that bubble become more viable, we'll invest in that. And then, I don't like to use the term bubble. These aren't bubbles right now, valuation-wise, they're very attractive. And then nuclear, we don't do nuclear. I sort of thematically like nuclear initially because of the CO2, but now it's just post-Fukushima because of permitting and because of storage issues. This is very, very weight expensive. So that's everything I have. Thank you. The summary I made before we take a few questions is that this portfolio is it's here and now. These are stocks that are investable and they're viable. And they're economic, there's strong growth. So I think it's a story that you can take out to the endowments and funds like this, like Progressive, like Trillium exist. We're institutional quality and out there to get shareholder returns and beat broad benchmarks, not just try to match sort of what happens. That's right here. Thank you.
Yeah, we've got 3 minutes of questions for you specifically before we open it up.
Alright, so I have a question. There's this account in UVM's endowment and we don't like it because there's a lot of fossil fuels in it. But the university says they need it because it's an inflationary hedge. Are there alternatives that are responsibly invested that can work, that can perform similarly?
Yeah, so Dan and I talked about this last night. I've done some work on this. Personally, I believe inflation's here now. When you factor in CPI, which should be measured with food and energy, it's way here. When you factor in globally how much emerging markets spend, the average consumer, on food and energy, they're spending up to 90% of their income on energy. The commodity prices are going through the roof. So think about this chart. So this is great. This is a soft and hard commodity index. No one is talking about this. Pension funds are investing in infrastructure, but no one is hedging inflation, and they're overweight to fixed income now at a time when interest rates are going higher. So it's absolute insanity the way the models are built around asset allocation. So clean tech is a natural inflation hedge because of the fact that when you think about these things, so as this happens, right, as it is, soft and hard commodity prices go through the roof, what do you need to do, and this is happening now, is companies want to control their commodity price exposure. So we're seeing water is becoming a huge input cost to companies, right? So they're using water filtration technology, that's silent on the bottom right, that's a filtration technology. They're using this desalinization technology, the yellow cylinder there, is now going to be used for industrial processing for semiconductor equipment because you've got all this water going to the plant, it's highly energy intensive, you save on your water costs there. So the idea is that as inflation rises, this chart will get exacerbated. Remember that since 2000, we've had a pretty stellar inflationary period. We really haven't seen inflation since 1982, right? That's when inflation ended. So we're going to have inflation, and when you have inflation, you need to have equities because you need to beat the indices. You need to have companies that are positioned for growth and mega trends. I don't see anything outside of biotech or energy tech that will create this long-term sustainable growth. And the beauty of this, and the way it makes so much sense, I know it makes sense to you, but it doesn't make sense to you right now because you're all trustees, but I know it makes sense to you as students. The point is this makes a lot of common sense. If we have visibility in this theme, this trend is not going away. So the endowments really need to think about positioning themselves with this. So in a period of inflation, you've got to put up strong growth and beat the index. And then we're exposed to what's called the small mid-cap portion of the sector. So we're not buying large companies, we're buying small mid-cap companies. Those are the kind of companies on a relative basis can also execute during high inflation. So it's a twofer, right? So from a classical asset allocation standpoint, you've got good valuations and have high growth rates. From a long-term secular growth trends, you have enormous opportunity for this also. And by the way, it's happening now. So LED lighting, natural gas engine blocks, energy efficiency. I was at a conference recently talking to utility executives. All they want to talk about is solar energy because it hedges their natural gas exposure. As gas prices go up, what happens is solar because they can put more distributed energy on the grid and save the bill. Okay, thanks.
Todd and Natasha, if you want to come on back down here, this is the general discussion. That was really great. Good job.
Okay. Two questions, please. Dealing with the world of Canada and energy, close to home. Keystone and the TransCanada company, and of course Western Gateway and Enbridge. How do you all feel about those as being inclusive or exclusive? And then the second one, what about if you're a holder of a large publicly traded oil stock like SoCal or in Canada, something called Nexen, and a foreign investor comes along, China, who's got a record that's completely disastrous in 6 ways to Sunday. How would you receive that? Proxy responding to a takeover bid, for example.
So I can speak a little bit to the first question,
Sure.
maybe Enbridge,
Yes.
because this is I think one of my early follies in And as we learned more and more about the oil sands, we're like, this is terrible. Like we can't be invested in this company that is benefiting from the growth of the oil sands. And so it's one that we took off of our buy list. Not that they're the ones doing the extraction, but that they're enabling that transfer. And you know, it just sort of the timing aligned where, you know, oh yeah, we need oil, oh my god, look at the oil sands, it's awful. So we changed course.
I'm somewhat familiar with this, but it's great to have two perspectives. So I have a question for everybody. I was wondering if you guys could explain some of the major differences between SRI companies and ESG companies.
Because it's a big
Yeah.
So you might have heard, like, I mean, we don't practice, well, we do some SRI accounts, but the SRI accounts we run at Essex or general sort of negative screening accounts and other things. My background is in SRI, my background is in ESG, SRI research. I was doing ESG at a company called State Street. I was very happy to break away from that and go to what I'm doing now, just for selfish reasons. I love clean tech. The differences are, and I don't know why you both look at me, then this is outside my career now. Okay. Sorry. I can just say that I think SRI is, ESG is more of a more institutional verbiage for SRI.
Yeah, I would say so.
Yeah, and then the only one to add is, before I let Natasha close it, is there's a lot of work that's being done around ESG and climate change, and but it's there's very large pensions that have signed on to the likes of the Carbon Disclosure Project is one, Ceres is another one in Boston. There's an investor network on climate risk, and so as you're out there talking to fiduciaries about climate change issues, be very wary when you get a trustee that says, well, we've done our part, we've signed on the CDP or INCR, because the issue is those companies, those consortiums aren't doing enough. A lot of them tend to be policy driven, and the policy, as you know, is very slow to come to the fore. And the other thing that's happening is that there's a lot of political pressure on a lot of these very large state endowments to sign on to these organizations. Then the treasurer says, I've done my part. Now, some of them are doing more. So some of them are doing, they're doing proxy voting, they're doing engagement, but there's been a lot of work that's been done on ESG and climate, but it's been very slow to move. And I've got friends that are at very large organizations that are doing ESG efforts that are at large consulting firms, and they're trying to push a rock up a hill. So what I'm saying is keep doing what you're doing at grassroots to work at sort of voters.
Yeah, and the other thing that I would add to this is SRI's, socially responsible investment. Over the last, since I've been involved in the field for the last 7 years, there's been a shift, and there's been many shifts in verbiage, and Todd alluded to this as well. But we sort of no longer say socially responsible investment. We now say sustainable and responsible investment, and that's because it takes away a little bit of the values judgment. It does make it more institutional. It shows that we're investing in these broader themes around climate change and energy efficiency and human capital and all and the whole thing. And then ESG is it's more institutional. I think it's an easier pill for fiduciaries to swallow, and especially on trustees and the like, because the ESG piece is really making the materiality case, and people tend to be more comfortable, especially financial folks tend to be more comfortable when you're connecting the financial case with the environmental, social, and governance case. And so there's certainly lots of reasons to draw those correlations, but it makes it's a tighter package. It's not all based on ethics. It's also based on value.
And I would just say what I'm trying to do is invest on a negative. So any growth investor should have exposure to green tech, no matter what their risk profile is, no matter what their ethics. They should have exposure to new energy infrastructure, which is a growing asset. And the last thing I'll just say is the great thing about climate change issues in 350.org and fossil fuel investment is that it's a unifying global issue. So a lot of the SRI issues tend to be very local.
local community development. And I heard Kevin speak the first time 2 nights ago. He spoke at my son's school. And then he had a slideshow where they're showing people that are affected by climate change everywhere. And so that's the great thing about the global equity markets is it's a unifying global issue too. So this can bring. So we need to think globally, act locally. We also need to invest globally. So we can do everything. We can do it locally, and you can also invest globally and help solve this global issue. So that's why I think it's catalyst.
I deal mostly in retail, one-on-one with clients. So I don't have this, deep political nuances. I mean, people just scream at me, I hate Exxon, or I hate Monsanto. So it's a different, you can't do it. A different world. I don't have to be so tactful, you can tell.
We have that too.
Question, I'm thinking as a trustee, with a large, investment, UBM or Delaware, whatever, it's a lot of money, and divesting of big oil, a lot of these companies are big, they're large, one of the largest companies in the world. They're seen as more stable, in terms of asset allocation, certain serving function there, and a lot of these clean tech companies are, speculative, smaller cap, can be stock in some cases. Not that there's something necessarily wrong with that, but it's not going to necessarily fill that part of the portfolio balance either. So how do you deal with that?
Yeah, so I chose to focus on where I think this is the most investment opportunity, knowing that I'm not going to get a large slug of equity assets because of the volatility of the asset class. So I don't like the term niche, but we are the foundation. We've had a couple foundations come in, and they're smaller foundations, but we're getting roughly 1/10 of them because they recognize the volatility of the fact that we're sort of small cap plus. We're almost big cap.
So to the students of Greta, we're talking, to people managing these endowments. So I'm sure the petroleum is more than 10% of the portfolio.
Yeah, so I don't want to speak to how you handle it, but I think there's firms out there. We are partnered. We're working with other firms where the consultant is placing the assets along with us. The answer is there's plenty of sustainability products out there across every asset class that we can. We're ready to go.
Would you read out your fund that look like larger cap stocks?
Right. We have small mid-cap strategies, we have large cap strategies, we have our sustainable opportunity strategy where we're divesting completely from fossil fuels. The question that you get to, I think it's one where because of sort of the conventional theories around benchmarking, wanting to own the whole economy, that it's an easy way for people to say, we can't do that. That's too risky. That's 10%. And I guess the question really comes down to what's your timeline? Is it short term or is it long term? And one of the biggest issues in the market is the short term driven goals that and you were speaking about the takers, right? The single hull versus double hull. And from a share from a management perspective, it might be great to be hitting the numbers every quarter. But from a shareholder perspective, if one of those things does explode, it's not just going to be that your reinsurance policy kicks in. That's going to be bad for your brand. It might lead to more regulation. It's not going to be good for anybody in the industry. So if you're thinking about divesting from fossil fuels and thinking about this whole issue with asset risk and the fact that maybe it is 2/3 of the reserves that are currently being valued aren't going to be valued because of legislation and climate change that comes down the pipe, then that's really not a good investment. And then the other piece of that is a lot of these companies are exposed to, because there's less and less oil, and so they're looking for more and more to keep these reserves up. And their stock values are based on more unconventional fossil fuels, so deep water, oil they're going to these frontiers. The problem with that is it's increasingly riskier and riskier. And there's an immense amount of hubris around technology will save us and we can do this. And you saw with Deepwater Horizon that wow, things mess up. People mess up. Stuff goes wrong, and it always will. And so, are we just waiting for kind of the next big spill to happen, or whatever? But anyway, so there's the whole hubris side, but there's also those assets. If you can start extracting as many reserves, in the future, those are the ones that are going to be left underground because they're the most expensive to extract. So the values of those companies will earn that, less than they should, or should be less than they are. So anyway, kind of a long way of saying, if you really think that this is a risk, then as a smart investor, you should avoid the industry.
I think what you're saying in a way is they're not as stable as you think they are.
Right, but
They're not
yeah.
secure as you think they are.
But it's getting away from conventional wisdom and timelines. What are our goals?
So, unfortunately, we are, actually 2 more minutes of questions. If anyone that we haven't mentioned has a burning question they want to ask, we can do it. Wrap it up.
We're going to be hanging around after.
Right, there will be a reception afterwards, but yeah, shoot.
Simple question. In your general experience dealing with portfolios that have social responsibility constraints for large cap stocks in the United States, do your portfolios generally outperform or underperform the S&P 500 compared to if they didn't have the constraints?
We've had outperformance for the last 3, 5, 7-year periods in our S&P 500.
The general index we use is scaling. Now I guess that they renamed it.
I think it's like maybe the MSCI, or we compare versus the mainstream dives, but
That's the best one. Into performance.
Right, so socially investing improves or reduces?
we've seen it improve. So we've had outperformance versus the benchmark over all of these periods, and the whole kind of theory behind our investment is that we're reducing risk and getting more exposure to opportunities that other folks aren't looking at.
Very interesting. Thank you. Great. Well, thank you. And now I'd like to introduce a very good friend of mine to try to he's going to be introducing a mechanism that he has been putting a heck of a lot of time into to try to put together a way to incentivize our university to adopt some of the measures that we've heard in the past hour or so. Dan Schmidt.
So I'd like to start by thanking Alex and our wonderful panel. It's really great to hear about how investment works instead of just struggling to find the right documents for us to send it online. So I'm Dan, I'm a member of Vermont Student Climate Culture, and I want to start off by talking about our first name. So we chose it because every word has 7 letters. Well, we chose it because there are many fiscal policy changes that the world needs, but the foundation for these changes, it needs to be cultural. And that's what this event's all about. It's about students providing energy for the solutions that the generation before us has discovered. Because, we inherit a lot of problems, but we also inherited their solutions. And culture is powerful. I like to believe that the bonds that tie together a cultural movement are stronger than the bonds that tie together profit seeking through self-interest. And I think we have to believe in that if we're going to change finance and change investment and fight climate change. So basically, we want to harness culture through the networks that have been set up by Divestment as a means of fighting climate change as a bridge to the new economy. Because we don't only want to divest, we want to invest in the new economy. And we want to go to school in the new economy. We want to work in the new economy, and which is also working for oneself and everybody. firstly, I'd really like to thank the New Economics Institute for making this gathering of the minds possible to connect us with these solutions and these speakers. And then also thank 350 for creating the cultural backdrop that enabled us to even be here in the first place. Actually, we've got a lot going for us in Vermont. I'm going to take off my blazer. It's almost like the organizing stars of the line. Especially in Vermont, we have incredible advantages. It's one of the few places in America where we still have true democracy, I believe at least. We've got a great nexus of nonprofits like BEEPR, businesses like the Intervale Center, governances, organizations like our progressive legislature, and educational institutions like UVM, all working together to promote something. And, I had a conversation with Will Rapp briefly at one point. He told me there might already even be a Vermont economy. And I can tell you, if we were to act upon all the initiatives that we talked about today in the summit, cooperative structures, a state bank, measuring progress differently, clean energy and responsible investment, well then we'd be pretty close. So my question is, in this nearly new economy, why are some of the most forward institutions still invested in what we need to put behind us? So that's what I'm going to talk about today. I'm going to talk about why we haven't divested yet, and I'm going to talk about how we can. And the answer to that second question is called the Responsible College Fund, set up by the Responsible Endowment Coalition and the Trillium Foundation. I might be pronouncing that incorrectly. But first on the first question. So why haven't we divested? I've been wondering, shouldn't UVM do it? We're really progressive. All our teachers tell us this. Our president makes these statements about why we need to take a greater leadership role in solving these problems, but we haven't done it. We've got 2,000 petitions at least. The Student Senate's voted. We're the first faculty senate in the country to support divestment. But no, we haven't made a difference. I'm the last person to doubt student power. I think it's incredibly important. I think that the whole movement of student power is what brought all this together. But there are some people, and I don't necessarily believe these people are at UVM, but there are some people who won't listen to student power, who think that their job is to ignore social considerations. And I'm just wondering, why aren't they listening? And then I realized it's what they told me. It's what I said a long time ago. The first time we spoke to the Board of Trustees meeting in a public comment, I told them, I said, we understand your fiduciary duty, and we think there's a way we can get growth and promote a more sustainable world. So I realized I was wrong. Not about the second part, and we heard from the investors about how that's possible, but about truly understanding fiduciary duty. Because I think a misconception of fiduciary duty is actually, it's the reason that we're not progressing forward. So I looked into this a little, and like all my revolutionary thoughts, I discovered that they've actually been discovered by people before who articulated them way better than me. And I'm happy about it. So it turns out that fiduciary duty, it's actually had a pretty dynamic interpretation throughout the years. It's rooted in Germanic, Roman, and Islamic trust law centuries ago. Translated to English common law in the early 18th century after the South Sea bubble. I'm not exactly sure what that was, probably an economic bubble. Well, after they decided fiduciary duty, fiduciaries can only invest in government debt and well-secured mortgages. But then in the 1830s, it changed again in Harvard versus England, where they talk about how the duty of loyalty, which is the principle at the core of this, can shift, and you can invest in stocks and all sorts of things. And then 39 years later, they reverted it, said only very secure mortgages and government debt again. Then in the 1970s, it was considered bad practice for fiduciaries to invest in stock. And as recent as 1992, venture capital, new companies were considered a very bad choice from a fiduciary perspective. And then most recently, the Employee Retirement and Income Security Act has said, we want to invest as a fiduciary exclusively for the financial benefit of the account. And we should behave as other prudent investors are, which right now basically means modern portfolio. So that's where we're at now. After all this progression, people are investing and they believe that their fiduciary obligation is in line with modern portfolio, which says we should focus on the total portfolio. And they really ignore individual concerns about what makes up a portfolio and look at these benchmarks and these different aspects of it. So in a world where modern portfolio theory equals fiduciary duty, we're living in a world where fiduciaries are trying to maximize the expected return on portfolio for a given amount of risk by carefully balancing the attributes of these different asset classes. It's using mathematical formulas and a lot of other things. How's it playing out at UVM? Well, we have all these asset classes, and we've got this one company, BlackRock All Cap Energy Fund. I mentioned it earlier, and it's horrible. I mean, we're invested in Exxon, we're invested in Shell in it. It's got maybe over half of all of our amounts of fossil fuels are in this one account, and also a bunch of other horrible companies. Alex, Lockheed Martin? Yes, Lockheed Martin. So, I was wondering, why do we invest in this account? It's got 85% fossil fuels. Well, of course, you know, it's in the real assets category, and it's a hedge against inflation. So, modern portfolio theory would dictate that it's okay because we're meeting our mathematical criteria, even though it's performed poorly. It's like negative 6% compared to our endowment growing about 9% over that period of time. So what we have right now is a fiduciary obligation that's emphasizing benchmarks over actual reality and the implication of that investment. And you know, someone said it a lot better than me. It was Ed Weitzner. He's a professor and director of the Henrik Center for Business and Law at the Osgood Hall Law School in Toronto. He said that, you know, there's a growing recognition, quote, a growing recognition that risk management for pension funds extends well beyond that which is captured by market benchmarks, extending to market integrity, systemic risk, governance risk, advisor risk, and the like, end quote. So that's a lot of how I see ESG investing unfolding. It's not that we're trying to be socially responsible, even though it is socially responsible. It's that we're recognizing that there are risks beyond which modern portfolio theory acknowledges. And that's why I'm still struggling with the whole idea of divestment, because fiduciary duty has been such a malleable concept throughout time, and now at the advent of the Anthropocene, when we have more change than maybe we've ever experienced in our history before, since, you know, microbial little organisms turned the world from an anaerobic to an aerobic. Josh Hartley says it a lot better. He's a good but we're having some major, we're changing the geology of our planet right now. But at this point, this is the point when fiduciary duty can no longer adapt. No, I think that fiduciary duty isn't to blame, but our interpretation of it is. And there are two main flaws that other people have found out, and I've been fortunate to read that. And one is the idea of the prudent investor rule. So we should be investing like other prudent investors. So this means everybody uses modern portfolio theory, and everybody invests the same way. So it's causing herding patterns in investment. And there was a really excellent article about this too. It's from the Rotman International Journal of Pension Management by someone named James Hoyle, who's the director of Elsenberg Center for the Study of Fiduciary Capitalism. And he said, quote, the use of index investment has skyrocketed. Furthermore, Ivinson's 2010 reports shows that 75% of a typical portfolio's returns come from general market exposure, which is the beta category, rather than benchmark outperformance, which is alpha. So the recent financial crisis illustrates this phenomena, which produced an unexpected global correlation of risks that locked over 5.4 trillion. So off pension assets in 2008 alone. So we're all investing the same way based on these benchmarks, and then no surprise, when something bad happens, our global pensions shrink by 20%. So that's one of the main problems with fiduciary, the interpretation of fiduciary duty. It's actually exposing us to a lot more risk than if we were to think critically about every company we invest in, like we heard from Bill and like we heard from Natasha. And it's very important that we try and understand that some of the obligations we may see and we may use to prevent divestment may be actually a scapegoat used to prevent divestment instead of a real reason. You know, we've gotten a bunch of really great reasons today from the investors. Todd talked about how the divestment movement's calling attention to people, but how we can use shareholder advocacy and focus on community investment. These are all great things. And he said that, you know, companies are being asked to earn carbon. This is true. I say it's time we ask them to stop. You know, Natasha, congratulations on expecting, firstly. But she talked also about how, you know, there's this unbearable hardness. So we're investing in these companies that market value is determined partially off expected future returns on a product, which, if we remove it from the ground, is going to cook our planet. So So fiduciary duty in its current term doesn't really account for systemic risk either. And then Bill talked about, he built an excellent case even for our current interpretation of fiduciary duty about why it makes sense to move away from fossil fuels and invest in these solutions. So that's a lot of what I wanted to say about the first part of fiduciary duty. But the second part is fiduciary duties, it's under emphasis on future value. So there's a report from Mercer, it's an investment consulting firm, that says that climate change can increase investment portfolio risk by 10% over the next 20 years. So isn't that something that we should be calculating into our investments? It is, and we're not. And if there is climate change, it can decimate global pension funds by destabilizing international markets. Or, for every 1 degree Celsius increase we have above averages, food prices go up 10%. I mean, we don't feel it that much in America, but people starve because of this in other areas of the world. So we have a moral obligation as well. And let's say we do fight climate change. Then still it makes sense not to be invested in these companies, because if we were to fight climate change, it would mean we leave carbon in the ground, which would mean it would decimate global pension funds unless we divested first. So where does fiduciary duty lay? It lays with the principles at the core of it, which are the duty of loyalty. The fact that as a fiduciary, you want to be loyal to the people in the account that you're trying to support. But people have fallen out of this duty. Right now, it's focused on the account. And we think at UVM, at Student Climate Culture, it's time to bring people back into the equation. So for example, we're investing in Exxon at UVM. How does that benefit the intended beneficiaries of UVM? We're not teaching our students here to go manage oil rigs. If we're investing in companies that are totally contrary to the skills that we're training our students with, how is that benefiting us? But the current lens of fiduciary duty doesn't allow for that. It doesn't allow for a consideration of people. So that's mainly what I wanted to say about fiduciary duty. A lot of other people would probably say it better. But when people are telling me we can't divest because of their fiduciary duty, I'd say, is that true, or is it because of the way we're interpreting fiduciary duty? So this is all great, but the question is, how? How do we change this? How do we divest? And that's really what I want to talk about. And once again, I think the answer lays with fiduciary duty. Not the holistic version I've been talking about, the current version. The perspective that reacts only to the forces of money. So at UVM, we're saying, you know what? If you don't want to listen to students, if you don't want to listen to faculty, if you want to listen to money, okay, we'll find a way so that you can listen to money. And there's someone, my dad generally told this to me, but I looked at the quote. It's by Jerry Stern, and it's called, from a paper he wrote called The Power of Positive Deviance, How Unlikely Innovators Can Solve the World's Problems. He says, it's easier to act your way into a new way of thinking than to think your way into a new way of acting. And that's pretty good advice. So I'm going to tell you about the Responsible College Fund. Exactly, they're excited too. So it's crazy that UVM can choose not to divest, not to listen to students, not to listen to staff, not to listen to faculty. But what about alumni? What about donors? At a certain point, if we can take ownership over our contributions, then we can convince the boards of the world where their duty really lays, and they'll listen to us. And there is a mechanism we can use to do this, and it's been my brainchild for a while, but then I was able to reach out to folks at the Responsible Endowment Coalition who are so helpful, and like most things, they had a way better mechanism that I'm happy to be able to present for the first time right now, and launch for the first time right here at UVM. And it's called the Responsible College Fund. It's a donor-advised fund. There's info about it in all your folders, for which given university is the sole beneficiary. And how it works is it's invested responsibly. No nuclear, no fossil fuels, no war profiteers. But there are conditions on it. Because I think it's about time that we say as community members, if you want our money, then you should listen to us. And you should uphold that duty of loyalty you have to us. So here's how it works. 5% of the donations that are given are released to the university every year for 5 years. And after 5 years, if we haven't met a certain number of criteria, which you can find in your folder, then the money's withheld until we do. And firstly, I have every belief that UVM is going to be able to be ahead of this and divest before 5 years. Because we're using both the stake that we have as individuals who are part of this community and the fiduciary obligations for money. So legally, by their own interpretation, if we can gather enough support, they'll be required to divest, which is pretty great. So, the last thing I want to do is hold the university ransom. And when I first talked to Dan about this, there wasn't a 5-year gap. It was just, that's how it was. You donate to this separate account, and it's either released or not released until they divest. But think about what we could do with 5 years. We're one of the most progressive institutions in one of the most progressive states in the country. In 5 years, we could gather enough support to send a message to the rest of the country, strengthen education immensely, and also start taking a leadership role on redesigning finance, which we all need to do. And if we can't do it in Vermont, if we can't do it at UVM, then we're not going to be able to do it in the country. So over the next 5 years, Student Climate Culture is going to try and fundraise $8 million for this account. By that time, we're confident that the university will be willing to understand that not only has the community made its voice clear on this, but their fiduciary obligation requires them to do this. We think that they will listen to student power, but if not, it's great to have the power of money on your side. Because that's the problem. When you think of the pension, for example, there's this exclusive benefit clause in the pension. It says you can invest only for the exclusive financial benefit of the people, the beneficiaries of the account. So firstly, I'd ask what beneficiaries? Aren't I a beneficiary of the account if I want to enter the account in the future? It isn't the pension supposed to perpetuate itself through time? But the question raised by some folks in the advocacy is, do we want to pitch this movement as a moral imperative or as a sound financial decision? I think this question is really at the core of all the efforts to divest. Another way of phrasing it is, why are we trying to divest? And the answer is, it's both. And we have a moral obligation to preserve the future of our economy. So that's why, starting today, Student Climate Culture is going to do everything it can to convince the country, to convince the university to make the right decision, both for us, for the rest of the country, and I've been out of time for a while. So I'll just end by saying that here are a couple next steps we can take. This is directed towards action. Firstly, in all your folders, you'll find more information about this. There's also a pledge form. I encourage all of you to sign this pledge form and say that next time you support the university, it'll either be through this fund, that'd be preferable, or it'll be not at all until they divest. And the second thing we can do is we can divest from the BlackRock all-cap energy fund in October and replace it with one or more ESG funds that invest in climate solutions, the things that we're being trained to go out into the world and do. So I'm wrapping up now. Essentially, we need to understand exactly where the duty of loyalty lays. And I believe it lays with us. It lays with future generations, and it lays with the ideals that I've been taught by this university. So thank you so much, and let's go hear Will rap. I'm pretty excited for you guys. And if you have any questions, check your piece of paper.